Very good morning. Welcome to Chartbusters. We kickstart a new series today. That's a September series, and we started off with good gains. We're up close to around 100 points odd. Remember, yesterday's expiry belonged to the Bears. Today, the Bulls have made a comeback. Hey, Manglam, what's up?
All good, Nigel. What's up? The market's up a century in the first hour of trade itself. September is known for big moves, right? Last September saw, what, 1,000-point gain? Let's see whether that sustains or not, especially because we're sitting on a 1,750-point gain over the last couple of series itself. And if we were to go 1,000 points from here, then it would be all-time high. Whether that happens or not, well, only time will tell.
Well, the Bears will have to sing, which song?
Wake me up when September ends.
Green Day.
All right, ladies and gentlemen, it is a green day, and we are both wearing green. Let's talk about all the top stories that we're tracking this morning as well. Strong start to the September series. Nifty moves above 17,600 as all sectors trade with gains. IT, metals, and PSU banks lead the way while the broader market outperforms.
Nelco signs a deal with Intelsat to provide in-flight connectivity in the Indian skies. The stock is currently trading with a gain of close to 10% locked in upper circuit.
Brokerage house Jefferies initiates coverage on logistics firm Delivery as a play on the fast-growing e-commerce space. Expects the firm to be profitable by FY 25-26 and sets a target of 775 rupees on the stock.
Electronics manufacturer and services provider, that's Skyrma, SGS, makes a strong debut, lists with a premium of close to around 20%. The stock is up 30% as we speak. We'll get the management in the next few minutes.
India Ratings reaffirms ratings on Spandana Spurti's NCDs and bank loans, also removes rating watch negative on the company. The stock, as a result of which, up 4%.
Well, let's start off the show then with the first corporate. We have Mr. Shah, the ED of Corporate Affairs at Symphony, who joins us to give us a sense about demand, how are things shaping up, and also how will margins pan out from here on. Hi, Mr. Shah. Thanks so much for joining in. Well, give us a sense, first of all, of demand on the ground, domestically, and also internationally. Various pockets of the world are going through a heat wave, and a rather brutal one. Are you seeing strong amount of demand? Because the flip side is that, some pockets are also seeing demand destruction. Go ahead.
So, fortunately, summer of 22 was exceptionally good, and we registered a record June quarter sales on top of unprecedented high inventory pre-season. So, actually, at a retail level, the sale was more than 3 times of the sales what company registered. And in continuation of that, we are also witnessing very robust, solid off-season collection in the months of July and August, which has to an extent surpassed pre-COVID level. So that indicates the demand and likely sentiments.
Right.
As far as the heat wave is concerned, we have decent presence in United States, Mexico, basically in North America, where there is a good heat wave, and we are really seeing a traction. In Europe, we do have a limited presence, but whatever we can do, there is a decent traction.
All right.
Coming to margin part, even in June 22 quarter, our gross profit margin percentage was in line with or slightly higher than pre-COVID June quarter, whether on a standalone basis or on a consolidated basis, despite unprecedented hike in raw material and freight costs. This was mainly on account of very smart model mix, introduction of new models, and massive value engineering, which we carried out in last 2 years.
Right. We take your point, and, I think the street also likes what you say, Mr. Shah, because as we speak, the stock is moved off the lows and, in fact, is currently at the highs of trade. The reason for that is that you're saying that off-season sales pickup has also been extremely strong. Can you then give us a sense of what are you looking to end this year with, and especially if you compare it to pre-COVID levels, because FY20 your revenues did cross that 1100 crore mark. FY22 you did come close to that, close to around 1050 odd crores. But the first quarter itself, which accounts for a fair amount of your revenue, you've crossed 300 crores. Do you think you will cross the pre-COVID levels in terms of revenues this year? And if yes, by how much, Mr. Shah?
No, certainly that's what we are aiming at, to cross over pre-COVID level by a decent amount. And we should be back to our normal growth trajectory as we used to register pre-COVID.
What would that decent be? If you could give us a sense, would it be double digit over pre-COVID, 20%, 15%? And, how would that growth be shaped up? How much of that will be India? How much of that will be all the other places? You're seeing what, 35, 40% growth in Mexico, etc. So can you tell us, the size of that growth and the nature? Where does it come from?
So I would not enter into any guesswork of the percentage of the growth, but what I can say that it should be in line with the pre-COVID era, when we used to register very robust growth. And that's applicable to standalone Symphony India business as well as our overseas and console business.
Okay.
And secondly, we took some heat in EBITDA margin in 21 as well as in 22, mainly because there was lower top line, there was a degrowth, which should also be restored back to a major extent.
Okay, all right. Mr. Shah, you're evading some numbers on the revenue front, but you're saying margins will improve from year on, and you're sounding confident that revenue, will grow at the same rate that you saw pre-COVID. We get that. But in terms of margins, your domestic revenue is already above pre-COVID levels, which is heartening. But on the margin parameter, if we look at the consolidated margins, they're still a little bit lower than pre-COVID. So what is the margin band should the street work with from year on a consolidated basis?
On a consolidated basis, we should be somewhere close to what it was pre-COVID at EBITDA level.
Okay, let me help you out, sir, then with regard to that number. You were doing high teens earlier. You were doing close to around, you were doing 16, 18, 17, 20%, 19% as well. That was in FY20. So are you headed towards the high teen?
Absolutely.
High teens would be 19%. That is the pre-COVID level.
Will be in the range of 16 to 19%.
Got it. We got a number.
16 to 19% is a broad range, but we will, given your optimism, assume that it would be in the higher end of that high teen, the band that you're talking about. But I'm just looking at a couple of other things as well. In the first quarter, you did increase your ad spends. I mean, it was almost 12% of sales. Going forward, what is this number likely to be? How are you looking at ad spends? And D2C as a proportion of your overall sales, how much would that be?
So normally we do have the highest ad spend in summertime, that is June quarter,
yes,
followed by March quarter. So I would say that almost 60 to 65% of the ad spend for FY22 we have already incurred. In September quarter and December quarter, we do have negligible ad spend. So remaining 30-35% should happen in March quarter.
Okay, all right. The other aspect is the way the US markets out there you have performed, which is really, really good. I recall you were at 1 to 2%. I think that number has gone up to around 6-7% odd. If you could tell us what is the market share you're looking at, particularly for the US market, and also the revenue growth. That's grown up big time. If I'm not mistaken, I think it's up nearly around 2.5-3 times, in comparison to what you were doing a few years ago. So this year, what kind of a number you're looking at in terms of revenue from the US markets?
So as such, about 3.5-4 years before, our US sales was just about 20 crore. In FY20, at a console level, our US sales is almost 140 crore. So grew by 7 times. In current year also, we should register a decent growth. But as of now, we are keeping the finger crossed in terms of the robust growth percentage, mainly on account of the local economic situation.
Right.
Otherwise, there is a huge potential, and apart from current business channel of Home Depot, we do have the local well-established brand on account of acquisition we do have the local established models, and we are also tapping several other channels in US.
Got it, sir. Mr. Shah, if you could tell us, what should your market share go to in the United States? You've grown big time from 2% to around 6%. Where's that number headed? Very quickly.
It should be easily in the medium term in double-digit percentage.
All right,
got it.
take that point. And, on India itself, 75% of the market, you said, was unorganized. Can you give us a sense of at what pace is the organized space growing? And have you maintained your market share between 40 to 50% that you've been talking about of the organized space? Because, raw material prices are increasing, and every other people that we speak to, they are saying that the organized proportion is increasing in the industry.
Sure. So here, quantity-wise, organized should be now about something like 27-28% versus 25%. Value-wise, organized should be easily around 40% of the industry size.
Okay. All right.
Secondly,
yeah, go ahead.
there is a gradual shift from unorganized to organized due to several reasons as known to everybody. And coming to our market share, we are absolutely in the range of 40 to 50%, in fact, in the upper range.
Okay, very quickly, cash in the books, what is it? And are you looking at any inorganic growth? Because you're talking about doubling your revenues in the next 4-5 years.
So it's close to 600 crore as on 38 June. And ours is asset-light, capital-light business model, and more than 90% of the profit is free cash flow. So we want inorganic growth just to deploy their cash, unless it is a compelling business opportunity.
Take that point. Always a pleasure speaking with you, Mr. Shah. Thank you for laying out the business prospects for us, sounding extremely confident with regards to the growth that you foresee in this year, with margins between 16 to 19% as well, maintaining market share in India at least at half of the organized market. The stock at the high point of trade. With that, welcome back. You're watching us here on Chartbusters. It's been a strong listing for electronics manufacturing services provider Syrma SGS Technologies. Sandeep Tandon, the executive chairman of the company, joins in. Opened at a 20% premium to its issue price, and now it's up almost 30-odd%, virtually at the high point of trade. Sandeep Tandon, the executive director, joins us now. Sandeep, thank you so much for joining in. Of the 840 crore IPO size, you're using 766 crores as a fresh issue, and most of that would be deployed into plant expansion and working capital requirements. Can you give us a sense? Okay, we're just trying to repatch that connection, just trying to, see if Sandeep can hear us or not. Sandeep, can you hear us? All right, we'll just try to repatch that connection. But Nigel, 766 crores is being used for plant expansion and working capital requirements. The revenues that they did in the previous year was closer to around that 1,266 odd crore rupees. So it'll be interesting to know the asset turn on the fresh deployment that the company is doing with regards to capex. Because even if it's a nominal 1.5 or something, then your revenues can actually grow almost 50-60% from where they are right now. And maybe that's why the street is giving it the kind of move that we're seeing, the optimism that we're seeing in the stock prices.
I think the pricing of the issue as well was fairly attractive, because you have a couple of larger peers out there, and we know what they have done.
Exactly.
So I think the street was quite excited about this proposition. And if they're going to be deploying bulk of that money that they're receiving for expanding capacity, they're doing 1,200 crores. You talk about taking 600 crores odd and, giving it a 1.5 asset turn approximately. Talking about another 900 crores odd. So, they'll be in the 2,000 crore odd mark. So let's see. But I think we've got the management back with us. Okay.
Well, we don't, but we will most definitely get the management back with us, and we will pose these questions to them as well. And more importantly, they are in a segment, the RFID segment that they are. That segment itself is growing upwards of 30%. So whether they can maintain their growth out there or not. And interestingly, Nigel, the last few IPOs that we saw, a lot of them were offers for sale or private equity players, moving out of the company, etc., or booking in some gains that they had made. There's one of those rare IPOs that we saw in the recent past that has a larger proportion of fresh issue as well. So we'll stick by and we'll wait by for the management to repatch with us. You stay tuned until then. And as we do that, let's also, in the meanwhile, get you some ideas for profit from our colleagues at Money Control Pro. Anubhav Sahu joins in.
talking about Balaji Mines, which had a good set of numbers in the quarter gone by on account of better product mix and higher volumes. Now, in current fiscal, volume growth is expected to be aided by higher capacity utilization for ethylamine, DMF, and acetonitrile plants. Company's dimethyl carbonate plant, which targets polycarbonates and lithium batteries and market, is also ready to commence production. Further expansion plans are underway for a few product categories. Among this, methylamine expansion is important as it is the building block of amine chemistry. On account of this expansion, methylamine capacity is expected to increase by 2 times. Now, in addition, value unlocking opportunities emerging for company's subsidiary, Balaji Specialty Chemicals, through an IPO route. Now, Balaji Specialty has scaled up significantly in the last 3 years and currently clocked 500 CR revenue and nearly 35% EBITDA margin. So this unit is targeting 5 key ethylene amine products for which it is the only Indian company having technology to manufacture it. Capacity utilization for this subsidiary is expected to jump to 70% from current 56% in the current fiscal. Now, as far as margins are concerned, we believe companies should be able to manage EBITDA margin range of 24 to 26% in medium term. Now, while key risk is demand slowdown in Europe, stock is trading at a discount to some of its peers and so requires a close watch in our view.
All right, thank you for patiently waiting by. Sandeep Tandon is back with us. Sirma SGS Technology, that's a stock on our radar. Sandeep, can you hear us?
Yes, I can hear you.
Perfect.
Thank you.
So, Sandeep, that's the first question that both Nigel and I, we were just discussing. 766 crore is the money that you're raising as fresh capital going into the company for both working capital deployment and also deployment towards plant expansion. Can you give us a sense of how much of that would be for plant expansion and what could the asset turnover on the expansion that you're going to undertake be?
Yeah, so about 500 crores of that proceeds are going for plant expansion. This is between greenfield and brownfield. We've already added one more plant in Manesar just recently this quarter that has just started, and one R&D center in Chennai. So expansion of R&D and greenfield and brownfield facilities that will be deployed over the next 18 to 24 months from the projections that we are seeing from our customers. Typically on the equipment assets that we put, we get about 5 times growth, but it does take time to build that out. So we have to prepare for the infrastructure first and then add more equipment and facilities in there. Within that equipment and facilities, we usually see 5 times on our asset.
Yeah, so Sandeep, you're saying growth. Sandeep, first of all, congratulations. Welcome to the stock market. It's a good listing. Seems you and the bankers priced it perfectly. You have larger peers out there, which has created some bit of excitement. And more importantly, the money is going back to the company, so the street likes that. But to take that point, you're going to be spending close to around 500 crores, 5 times asset turn. Is that correct, what you were talking about? 5 times asset turn. So at peak, you can generate. Yeah,
so 5 times on equipment turn. So yeah, so between infra and so infras, we have to expand further. So that doesn't give return right away.
Okay.
But when we start adding lines and equipment, that those give about 5 times turn.
No, so what I'm trying to understand is this 500 crores you're going to spend at peak levels. What kind of revenue you can generate from here?
So about 2,000 crores from this.
2,000 crores is what you can generate from only this expansion. And last year you did around 1,250 crores with the old capacity. At peak levels, what can that generate in terms of revenues?
So that should be another 2,000 crores.
How is it that 1,250 crores also accounts to 2,000 crore and the 500 crore that you're doing is about 2,000 crore as well? Is there a difference between the two? And can you also give us a sense, because I'm looking at your
current last year's turnover you asked, right? I'm not sure.
No, I'm talking about the capex that you did last year.
No, we didn't do 1,250 last year. No,
okay, so 1,250 crore is the revenue that you did last year, and 2,000.
The revenue. That's why I was confused. But yeah.
Okay, take that point. So you're saying that this 500 crore can yield you revenues of almost 2,000 crores. But apart from that, you have some other gross block as well. I mean,
but
11 plants.
What we are currently currently working. Yeah.
So you're currently working at what capacity utilization?
So we are currently at about 75% utilization.
So peak capacity on this would imply revenues of close to around what, 1,600 odd crores?
Yeah.
Okay. And by when?
I didn't catch what you.
No, by when? By when? Okay, so what we're trying to understand.
So we are expecting. So yeah, go ahead. Maybe I'm not understanding the question.
No, we are just trying to get a sense that at peak levels, what we understand now, going by your current capacity as well as your expanded capacity, you can hit around 3,500 to 4,000 crores. Is that correct?
Yes, correct. That's
okay,
correct.
all right.
That is correct.
When does the expansion come on stream? This 500 crores that you're putting on?
So we've already started, like I told you that we've started expansion already. One plant in Manesar has already been acquired, and we've just started this quarter, fired that plant this quarter. And R&D center in Chennai is just started also, that we started last month. That is another expansion that we've already done. And that will, and then there are about 2 other brownfield expansions and 1 greenfield that should start over the next, like I said, 18 to 24 months. We should be able to deploy this.
It's interesting that you are, deploying some money towards plant expansion, because from what I see in your red herring prospectus, you have about 11 manufacturing facilities, of which only 4 contribute to majority
Correct.
of your revenue. So what happens to the remainder 7? Are you looking to
Correct.
offload them, sell them, or you are?
No. So India has to be managed in a very different way than China. So we don't believe in one large plant. So we actually have what are these other plants are what are they called satellite facilities, where the capex is not heavy. It's more to be closer to workforce where there's labor intensity. So we try to do a lot of labor intensity closer to where the workforces are, and then we drive those plant to the parent plant if required. So,
okay.
So that's why you don't see all the plants being equals. They're actually very strategically done so that we have more, it's a way we're playing India out, right? Because moving workforces is very challenging. One large facility, you don't have disaster recovery plan. So that's how we played this out. So it's actually the synergistic plants that we think of the way we do it.
All right, Sandeep, let's pick up the pace now. ODM as a percentage of your total revenues, I think is around 30%. Where is that number headed?
Yeah. So I think it should stay there because there's a lot of growth coming. So 28% is what we are at, and I think we should continue being about 28 to 30% in our ODM capability. Now that we're adding much more R&D over maybe next 2 years, that there could be opportunity for growth in that capability.
What's typically going to be the R&D spends per year, Sandeep?
So R&D spends are, they're not, they're not huge spends because we actually, it's a revenue source for us, right? So we don't burn the R&D. It's part, we work with the customer, so it's actually billed to the customer through the product. So
and what is the average tenor of customers that you have? Because what's the average tenor of customers that you have? Because last year you added what, 158 customers?
No. They were not added last year. So we have a total of. So what we do with the customers, right? When we initiate a project, it becomes what we call a NPI, which is new product introduction, or a prototype build. So that we want to keep a very large funnel available. So these customers eventually will turn into revenue generating, huge revenue generating customers.
Okay.
So we engage with customers because with our engineering skills, and then we supply them the prototype, and then some fall into revenue, some don't. But these are customers but our tenure with our customers are extremely long. We have customers who've been with us constantly for 16 years, and we continue
Sandeep?
to engage with customers. So very, very rarely. Yes, sorry.
Yeah, Sandeep, let's wind this down. Then we got your focus, but very quickly, what is your revenue number likely to look at for this year? 1,260 is what you did last year, and your margins last few years have been between 11 to around 16%. So for this year, what is the margin band? Very quickly.
So we want to stick to the same margin profile that we had last year. That's our aspiration. And growth we want to hit. We are aiming for industry is growing at 40%. We should try to match industry growth. So
for this year, you'll do around 1,700 crores of revenues at least, with margins of around 11 to 12%.
Yes.
All right. Take that point,
yes.
Sandeep. Thank you so much for joining in. Congratulations once again.
Thank you
for entering D Street. The important part now will be maintaining the growth and going ahead and meeting your word with your action out there. That's how it pans out. Both of us will speak to you on a quarterly basis as well. With that, we wrap up on this edition of Chartbusters. Stay tuned. Trading Hour comes up next.